Welcome back to season 2, episode 8 of the Kansas City Commercial Real Estate Market Pulse. I'm Logan Freeman. Our guest today is Bruce Fraser, managing partner of Elkhorn Capital Partners. I will introduce Bruce here very soon. But welcome back to the Kansas City Market Pulse. We had a jam-packed session, last week. We had 3 jam-packed sessions last week. So only 2 episodes this week, but we're excited to have Bruce here as well. But I'm Logan Freeman with Midwest Commercial Real Estate Advisors. And, today we're going to be diving deep on a data-driven conversation on commercial real estate and multifamily with somebody who I've followed for quite some time and love reading his posts on LinkedIn, his thoughts and his opinions. It's just something I like to, I do have a master's in business administration, and, I didn't take a whole lot of economics classes in school, but getting into investing and commercial real estate, I have found that understanding trends and cycles has really helped myself and my clients. And that's a big reason that we're hosting this podcast here today. We really do host this podcast for one simple reason, and it's because clarity beats noise. There's no shortage of headlines. I mean, I just saw Dave Ramsey post on LinkedIn or wherever the other day, still talking about how, institutional investors are buying up all the single family homes, when if you actually look at the data, that would suggest that is an incorrect statement. Now, there are specific markets that they have a higher concentration in, but from an overall landscape, what he was saying was a very different perspective, right? So there's a lot of headlines out there that we want to kind of get through, and we want to cut through that noise. If you're interested in talking with our team about Kansas City commercial real estate, please find us. You can find us at mwcreadvisors.com. We're all over LinkedIn, social media. But here's our team. We range all the way from medical office buildings, dentist practices, leasing, tenant representation, landlord representation, small bay industrial. We're doing work in data centers. We have multifamily and office, and each one of these individuals specializes in one of those asset classes. So please do reach out to us if you have any information that you'd like to learn. And I got a shout out to Amy Silvis, because Amy's already here. She's saying that she's excited for this. Thank you for being here, Amy. You are a wonderful person and an absolute blessing to not only the commercial real estate industry, but our world at large. We need more Amy's out there for sure. All right, let's introduce Bruce. Bruce is managing partner of Elkhorn Capital Partners and a former hedge fund manager with over 20 years as an entrepreneur and a fiduciary investor. A disciplined quantitative investor, he uses macroeconomic indicators to drive a top-down investment strategy and oversees more than $500 million in investor assets. He's completed over 100 real estate transactions, successfully navigated multiple market cycles, something I'm super stoked to talk about, and including, this is a huge one, avoiding the 2008 and 2009 housing crisis, right? The GFC, and specializes in distressed and capital structure-driven real estate opportunities. So, Bruce, thank you so much for joining us. Thank you for being here. But for those of us that might not know you yet, give us the quick background on your journey from hedge fund management into real assets, into multifamily and real estate. Love to hear that journey.
Yeah, it's all data driven, like you said, and I think either you grab this off of something stale or I gave you something stale, but it's actually, we oversee $1 billion now. It's double that, so it's grown quite a bit. But yeah, so I was running an absolute return strategy and ran that for about a decade. It was an options-based strategy, but it's just managed to make a steady return no matter what. And I had been an active real estate investor back then with just one business partner on a pretty small scale, but we were ultimately at our highs at the troughs of '09 in that public market strategy. And, post GFC happening, I felt like, there's absolutely no way we get out of this without the Fed printing a ton of money, which was going to be highly inflationary. So I pivoted a lot of my time and capital on focusing on hard assets. I still oversee, 650, 700 million in the public markets. It's a quantitative strategy as well, a separate company, but focus a lot of my time on Elkhorn Capital Partners, which we formed in 2010. As you mentioned, we sold all of our investment property in '07. And, I felt like by 2010, it was time to really start, you felt like the dust was starting to settle and it was time to start re-engaging. If you think about that time period, banks were still not lending in 2010 because they were taking so many losses. I mean, they were allowed to change the accounting rules where they didn't have to mark to market, so they were still pretending that their assets were worth what they thought they had them on the books for, but they were not liquid enough to be lending money. And so initially, Elkhorn was just focused on some smaller stuff. We were buying assets from banks, single family stuff, doing some owner financing, hard money lending, things like that. But a couple years in, things had gone well. We started sending money back to partners, and at that point, the party was kind of back on. Music was going again. Banks were starting to lend. And I didn't like the transactional nature of what we were doing. I wanted to focus on larger assets that we could hold for a longer period of time. And so became singularly focused on multifamily. That's all we do. We're showing things all the time in different asset classes or different areas. And we're just like, what, that's not in our lane. And so we just do what we do and do it pretty well. But I like the asset class. To me, it has the best risk reward of all the different hard assets that you could invest in. I wasn't wise enough to see that the office paradigm would completely shift, but I didn't like office or retail because they're too tied to business cycles, and I didn't want my outcomes to be tied to business cycles. And so, we did end up focusing. We started actually in Dallas, Fort Worth. There's a ton of money chasing deals here in DFW. Ultimately ended up doing a little bit in West Texas because cap rates were so compressed. People were paying us basically 4 caps for C assets that were already 100% full.
Wow.
So it didn't make sense to me. So we did a lot of quantitative research on different markets. Actually really like Kansas City, by the way. We almost started buying in Kansas City, but we did a field trip up there with the whole team, met with some different brokerage groups, spent some time there, ate way too much barbecue. And that was, we were just about to start buying some stuff, but it was about 2 weeks before the lockdowns. And so one of our rules is we have to be able to get there by a direct flight on Southwest or 4 hours or less by car. Because we're very active owners, we want to be on the assets. What we ultimately ended up focusing on, because cap rates and just we didn't want to hope that we could flip the deals to the next greater fool at a lower cap rate. So we wanted a clear path to making money, and we ended up developing a specialty in distressed acquisitions that, as you mentioned, formerly they were really management driven or assets requiring new strategic capital to catalyze a positive change of the property. But more currently, the last few years, it's really, there's a lot of capital structure distress or partnership distress that has created, hard times. People tend not to get along as well. And so brokers know what we're looking for, and people ask us where our deals come from. We just answer the phone and see if it fits our box, because, be a situation where broker partners are suing each other, or LPs are suing the GPs, or, we just bought 4 actually in December. We've been sitting on our hands for 18 months. We've seen the distress and kind of the phases of it mature. And myself and my right-hand guy, we had, promised we weren't going to do a fourth quarter deal, December close again, but we ended up buying 4. You can't control when the deals come to you, but 2 of them were the same seller. They were hard money loans up against the maturities that were going to be in default. They messed around and weren't focused on the timelines, and they reached out to a broker that we know and said, I need you to market this. And as you know, it takes time to put together the package and get it out to all your people. And they said, we don't have time to market this, but we know a group that can and will close, but they're not going to pay you what you want. And so that was 2 of them. And the other 2 were more traditional operational distress, single asset owners from out of state that were using third parties that were just terrible third parties and have kind of run them into the ground, and they were just desperate to get out. So, you do the deals when they come. You can't, it's honestly, brokers have always said location, location, location. That is really important, but I would argue timing is even more important. And, how you buy it is so critical, as you know.
Yeah, 100%. Thank you for that. I forgot to mention, if you do have questions, please do drop them into the comments. My team and myself, we are navigating and evaluating all the comments in there. So if you have questions for Bruce or for myself, please let us know. We'll be getting to those here shortly. Okay, so, as a younger person, right? I turned 36 this year. I have been in real estate for almost 10 years now. So you got to think about my time coming in was like 2017, right? So like, during the GFC, when you were navigating that, I was playing college football, right? Not even thinking about capital flows and I didn't even know what a cap rate was at that time, right? So I started to study people like Howard Marks and Ray Dalio and Phil Anderson and Sam Zell to try to understand these real estate cycles and how things move and change. So when you start thinking about reading the macro landscape and maybe giving some people some indicators and or some strategies to do so, like, I mean, it's so it's a very daunting task when you and I literally have macroeconomics books that I have read in the last couple of years just to try to get schooled up on it. But that can be very intimidating for a lot of people. How do people get started in understanding how to read the macro landscape and then that actually directing their investment strategy?
Yeah, I mean, you don't have to get too deep in economics. I mean, I'm eco-finance undergrad, as you mentioned, and so I just kind of think that way, but it's really simple. It's, if you think about just day-to-day goods that you buy, if there's more demand for the good than there is product, then the prices, you're going to have to pay more to get it. And, just that simple concept alone is critical in analyzing assets that you're purchasing, markets that you're buying in. Some of the quantitative things we look at when we're looking at, the two different points here. I guess one is the macro of, why we think that we should be in hard assets, and I'm happy to dig into that a little bit because I think that's so important. I mean, I've been on panels at conferences, and I mean, I argued many years ago with some of these people because they're saying how late stage we were in the real estate cycle. And I was almost of the attitude, you're missing the entire story. It doesn't matter where we are in the real estate cycle. What matters is the macro context with the US dollar and currency debasement and all of that. And that has certainly proven out. But,
Yeah.
More specifically or more granular on the micro component is, I'm seeing so many people struggle in certain markets. And to me, it was absolutely clear that that was going to be a tough market because we did the research. It's all publicly available data. Look at how much supply is coming online. I'm sure your team monitors that. That's pretty important, pretty damn important.
Extremely important.
Is there job growth in that market? Is there population growth? How affordable is the market? That's one thing a lot of people missed in Austin. It's a sexy place to own and buy and develop, but you know what? They can't raise rents because nobody can afford it. The median percent of income that people spend on housing is roughly 30%. Austin's well above that. These 4 deals that I just mentioned to you that we just closed on, after we do renos and after we upgrade and increase rent substantially, we're at anywhere from 22 to 26% of incomes in the 2-mile radius of the properties. And so still very affordable. And that is critical. And, we're hearing from lots of people that, they're having to pull back on rents or, they're not getting the growth in rents. And we're just not seeing that. But part of that is because of how we target assets and the types of things that we buy. But, clicking back up to the broader macro, the government's 38 trillion in debt, and that is growing at a very rapid and accelerating rate. It's roughly an added trillion every 3 months, 60 to 90 days. We were under the debt ceiling for about 6 months, and I think they added 2.3 when they reopened because the debt ceiling doesn't mean they stop spending; they're just not paying their bills. So it's still accumulating. So that would imply that it is accelerating. The higher the rates, or the longer that the rates stay this high, more and more of the debt is resetting at the higher rates because our average interest rate on the existing debt's roughly it's 2% and change. If that starts resetting at 4 and change, that's more than double on your interest payments. And just to put that in context, 28 trillion of that 38 matures over the next 4 years. So if you divide that, what is that? Roughly 7 trillion a year. Well, and during COVID, I think we printed 3.5 trillion. And look at the inflation that we got. So double that and do it for 4 years in a row. So it's our view that we're going to have high and sustained inflation. They will not show that; it will not be fully reflected in the CPI. They've changed the CPI calculation dozens of times, always with a resultant lower number. So it's by design. So you have to measure things your own way, but certainly all the goods and services I'm buying are going up by more than 2 or 3% a year. I know.
Yeah. Well, I mean, your point, the point I want to bring this point home, I think that in regards to the housing, that the indicators they use for the housing is they survey homeowners to say, if you were to rent your house out, what do you think you could get for a rental rate? Like, why would that be a part of CPI? Like, why are we asking homeowners what we think we can rent their houses for, right?
Yeah,
Like that's
and
legitimately a part of it, or it has been in the past.
for sure. And fully 1/3 of the CPI is what they call owner's equivalent rent, which is what you're talking about. And when we printed a 9% a couple of years back on the CPI, they were saying OER was like 2 to 3%.
Mm.
Well, I mean, housing prices were doubling during that period of time. So I don't know. The data is just incredibly skewed. So,
Well, when we think about like real estate cycles, right? Like something I'm fascinated with, trying to learn about real estate cycles. And I'm looking at the book by Ray Dalio here, The Big Debt Crisis, which I'm sure you are aware of, and just some of his analysis on that. He speaks about this a lot. And obviously we have the proponents of modern monetary theory and things like that coming in. But, I will say that like I have enjoyed reading folks like Phil Anderson and Akhil Patel, and they've been on the show just discussing kind of their framework of looking at the last 200 years in the United States of the land cycle and prices, and trying to find out a way to say, hey, there's like the 17 to 22 year period, right, of time where there's a pretty predictable up and down swing of real estate. Now, it's very interesting. I love reading about all of this and understanding the reasoning behind it. What I'm trying to kind of figure out is when the government steps in during a COVID-19 period of time and inflates prints $3.5 trillion of money, like how does that impact these real estate cycles? And then, how the heck do people try to think about where we might be at in a real estate cycle? Because that kind of gets people waiting or not doing anything, and then they miss the boat, right? Because good golly, asset prices the last 3 to 4 years have been on an upward trend, and I don't see that changing this year either. So again, just getting confused, from a lot of different perspectives out there to kind of try to navigate this. So just wondering how you wade through those waters.
Yeah, it is complex, and most people don't think about. Most people just think about interest rates, on a nominal basis. They
Right.
don't think about real interest rates, and that's if you take the interest rate and subtract off inflation. And even after the rates started increasing in 2022, the Fed increased rates at a historically rapid pace. A couple things there. Like, I absolutely was dumbfounded that number one, so many people were on floating rate debt as they were. I haven't run across any other operator that has any scale that was 100% floating like we were. I mean, 100% fixed like we were.
Mm-hmm.
But we knew why we were in the trade, so to speak. We're in the trade because we view inflation is going to be high and sustained. And if that's our view, then interest rates should be increased. And so we wanted to fix them. I mean, if you could borrow at 3%, 3.5% for 10 years, why in the world wouldn't you? Could the rates have gone down some? Yeah, I mean, maybe a quarter point, maybe 50 bips, but could it asymmetrically, go up? Absolutely. And that's the higher likelihood. And so, a lot of people that do multifamily, they're in it because they flipped a few houses, they wanted to go bigger, or they went to a conference, or they saw everybody making a ton of money, and they didn't really know why they were doing it other than to make money. And so they didn't position themselves properly. And I was at an offsite with probably 15 other operators, maybe 20, and top tier people. And one of the guys, he reads my LinkedIn post too. He's like, "Man, I thought you've been saying multifamily is a great inflation hedge." And he was heavily invested in Houston, where you can't raise prices because supply is so easy to build there.
Yep.
And then he hadn't fixed his costs, and so he absolutely got destroyed. And he wasn't paying attention to the thesis of why. And so I think that's really important. But knowing where you are, I do believe multifamily is a great inflation hedge if you're buying in a market where you have pricing power, and if you're fixing your expenses multi-year. I mean, we're going to vendors and trying to get multi-year contracts with them where normally we would not do that. But paying in today's dollars versus 3 years or 5 years from now is going to be the way to go. So that's really important, and I think a lot of people miss that. They just get an OM from a group. It's beautiful, and you guys do a great job of making it sound like it's it's all going to be upside, and sometimes it is. But they don't pay attention to the market necessarily. And like I said, we really like Kansas City. I haven't checked on it recently, but it was at least formerly one of our top 10 markets.
Yeah. I mean, there's from a supply standpoint, anywhere between 3,500 and 4,000 units a year delivered here. We're absorbing that new product as well. 25,000 people are moving to Kansas City on a regular basis. Many people ask me, why are we continuing to build all these, multifamily properties? Who's moving into those? And I'm like, well, do you know what the population growth is? Do you know what the job growth is? Well, no. Well, we've got 25,000 people moving here.
Yeah.
The renter profile is changing. Not a lot of people are buying their first single family home until they're above 40 years old now. I think that was the figure I heard the other day. So a lot to like about Kansas City, obviously.
Yeah, for sure. And that's a great point. That you've got a whole generation that are really being priced out of first time homes, right? Because the homes have gone up much more rapidly than incomes have. And so,
Yes.
I think something like 2/3 of first homes, the the children are being helped by the parent to get that done, because it's almost unattainable unless they just wait a very long time. So that does create a, a lot more renters for longer, and as does just the mentality of, there's a whole generation that they've grown up in an environment where they rent everything. Spotify, they rent access to their music instead of buying a CD or a download, and they've just been trained to do that, and so they do.
We have cars now that have a subscription model for
Yeah,
full self-driving or for seat warmers or whatever it is. Everything's on a
yeah,
subscription, right? I mean, that's just,
absolutely.
I
Yeah,
mean, you can go on Amazon now, buy something and use Afterpay and pay later, right? Like
yeah,
it's mind-boggling, right? And I know I'm only 36 years old, but like, I've lived through where you had to go to a store and pick something up and pay for it there. And I lived with a debit card where if you didn't have the money on the debit card, you didn't buy it, right? Like
yeah.
you didn't have the money to do it, right? So, anyways, I love discussing that. Well, let's move on to something maybe that's like really pressing right now. And I put a nice little, you know, thing up here about Elvis Presley because I think that there's an old line from his concerts at the end of the show. The announcer would say, "Elvis has left the building," so people would actually finally go home, right? And in this previous week, this is from Manus Clancy. He's an economist over at Lightbox. Very much enjoy reading his content. But this week after a really weak retail sales, it kind of sent Treasury yields tumbling, and it felt like he said that it felt like the market might be finally saying higher for longer has potentially left the building. But for months that we've been stuck between two fears, right? Inflation still being too hot, and then recession being worse than the data suggested. Well, then the BLS revises, 108 or 898,000 jobs lower for 2025. I mean, that's enough to erase the wage price spiral narrative that has been out there in the market as well. And then in January, this past month, 2026, jobs come in strong, 130,000 jobs added, unemployment at 4.3%. So we've got softer past data, we've got resilient current data, and Treasury yields suddenly are breaking a little bit lower on weaker retail sales. And so, like, the Fed is in this unique position where I think they're in the hardest part of this, quote unquote, soft landing. And I just kind of wanted your take about what's going on in the market right now, because I've heard from a lot of operators, and obviously I track transaction volumes, right, from a brokerage standpoint, right? And Q4 of last year broke all records of what been forecast at $545 billion done nationally. That was up 16-17% than what economists actually thought. So what's your take? Are we witnessing this soft landing, and what are some of these economic warning signs that we should be watching right now?
Well, I've already touched on the CPI data, but the employment data is probably even worse and more manipulated.
Mm,
So there are a couple of different variables there. One is not a data issue; it's just a paradigm shift issue. And so the jobs data had formerly included immigrants in the number, and so if we're focusing on not letting as many immigrants in the country and actually removing some, then the expected job growth count should be lower, just without it being a negative on the economy necessarily. But the number is going to be lower than it used to be because there aren't going to be as many immigrants here, most likely. So that's important. The other thing, the jobs data counts a part-time job as employed. And so some of the job growth that we see are actually people getting a second job because of inflation. And so, it's very misleading data. The BLS that puts out the data, they put out a couple of different reports, and one is much more accurate than the other. But one easy way to look is just private data. You can easily see layoffs that are being announced because they have to be announced if they're over a certain size. for HR reasons, different things like that. But yeah, I think it is kind of early to tell. A lot of people talk about a K-shaped economy. What that means is the people with financial assets, real estate, single family rentals, multifamily stocks are doing extraordinarily well. And the people that don't have such things, they're working for a wage, are getting squeezed by this inflation, whether it's reported inflation or not. There's hamburgers are more expensive to buy, ketchup's more expensive to buy, the rent's going up, all these things. And so you do have kind of two different concurrent economies. One yet to be determined variable is AI. AI is going to have a lot of benefits, but it's also going to take out a lot of jobs, most
Hmm.
likely, and already has to some extent. Where those are going to be concentrated, I would anticipate they're going to be more white collar jobs taken out. Most of our we do focus on workforce. I know you're going to get into workforce a little bit later, but most of our tenants use their hands to work, and that's something that AI can't replace. And so, I think we're de-risked from that to some extent, but we do have the risk of inflation squeezing our tenants, for sure. But I think that there are going to be a lot of opportunities economically. I think that I would not want to be Chairman Powell or Warsh, who's the proposed incoming, because it's they've been given a puzzle that's unsolvable. It's really too late to solve it. We're at a point now where if we had the best historic growth rate in the country that we've ever seen, we couldn't pay off our debt.
Hmm.
It's just not feasible. And so, there I always have said, and I've said it publicly a bunch, but there are four things. I've always said there are four things that they could do about the debt. I would add a fifth now because that's actually the current strategy is, and I had this on a recent post, so you may have seen it, but they could raise taxes, which a lot of people clamor for, raise taxes on the rich. Well, you may have looked, but California just proposed a wealth tax, and guess what? All the billionaires are fleeing.
Yep.
So,
Yep.
they on paper it looks like they're going to raise a bunch of money, but in reality they don't because money's fungible. Same thing happened in France. They raised same kind of thing in France. All the billionaires left. In New Jersey, they were raising state taxes. One of the hedge fund managers there left to go to Florida. It impacted their state budget 8%. That
Wow.
just the one guy leaving, and they begged him to come back and like, you've already shown your stripes. I'm not going to get trapped here. And so, we can't mathematically, if you look at it, raising taxes, even if they took 100% of our incomes, would not pay off even the current year's deficit. And so that's not going to solve it. Cutting expenses. A lot of people are hopeful about Musk and Doge, all these geniuses attacking these really messed up, unorganized problems. And there's so much political pushback that it's not going to solve the problem at all. It's not going to hardly make a dent, unfortunately. They could default, which they won't do. They've said publicly they won't do, and they can print money, so they won't. Every country in history, they have, when they're in a debt crisis like this, they have a choice. They can destroy the currency, or they can destroy the debt, which basically makes it so they can't borrow and they lose all power. And it's just every single time they've always chosen to destroy currency, which brings us to the fourth item, which is inflate. You need high and sustained inflation by design. They won't show it because they don't want people to come after them with pitchforks and torches.
Right.
But that's the plan. No matter what they say, you have some people come on and say, "Oh, we want a strong dollar," but that's the actions speak louder. But what Besant has said is, he said, because they tried all these different things. He's like, you know what, we're going to grow our way out of it. Like, well, okay, that is feasible, kind of. I mean, the problem is our debt's growing at over 10% per year and accelerating. We only twice in history have we ever had GDP growth for even 1 year over that level, and one was coming out of World War II, and obvious reasons for that kind of growth. And in modern history, it's never occurred. Probably the peak is usually around 5% or so, which is where we're running right now. Now, part of what shows up in GDP though is inflation, right? So inflation makes it look like there's growth, but on a real basis, it's a lower growth. So I just call BS on that. I don't think they're going to be able to grow it more rapidly by focusing on growth and reduction in rules and bureaucracy and all that. They may stimulate more growth, and that'll be great. But that's also inflationary too. And so we want a position for what we view to be almost a completely certain outcome.
Hmm. Absolutely. Yeah. Well, lots to unpack and think about there. I mean, one of the things that I put up here was that I like to track on a regular basis too is home builder confidence and just being timely with the Super Bowl. It's right now weaker than the New England Patriots hope late in Sunday's fourth quarter, right? I mean, and if you watch that game, you know that that's saying something. But I do find it fascinating to kind of watch what happens in the single family home world because it happens so much faster than the commercial real estate side of things, right? And even in Kansas City, sellers are not demanding the prices that they once were, right? And so, do you track anything in regards to the single family home market, just from a confidence standpoint, the consumer standpoint? Is that something that's on your radar?
One of the things we look at is how much does a single family property cost in the area where we're trying to rent, and how much
Hmm.
would a mortgage payment be relative to that? Because when we were in West Texas, we did run into a cycle where one of the area banks out there was giving the basically fog the mirror loans, and so and housing was so inexpensive. House might be 150,000 dollars at the time. They could go get a mortgage and for a single family home, which is obviously more attractive than an apartment. But a lot of those first time home buyers didn't realize the full cost of ownership.
Right.
Take mowing the lawn and when the air conditioner breaks and all those different things. But you can end up competing with single family properties, and so you have to be careful about that. So we do monitor that. We monitor price to rent ratios, things like that. And that's one of the reasons we got out in '07 is there was just an absolutely parabolic price to rent ratio, and we knew it wasn't sustainable. And so we took our toys and went home.
Okay. So you said previously that you were kind of sitting in the camp before December for 18 months. Let's talk about, what we think that is going to drive maybe transaction volume, get you guys continue to come off of the sidelines. Obviously, you focus on the distressed assets, but one thing that I've talked to a lot of operators on is if that 10-year treasury really does stick around 4% and break below 4%, that's kind of the deal making, threshold. Is that something that you're looking at for yours, or because you're buying distressed assets? I mean, your basis is going to be where it needs to be regardless. Is that something that you're kind of looking at or expecting to kind of break before, this year on the 4% standpoint?
Yeah, I mean, there's expectation. There's how we model things. Like these four that we just bought, we're modeling. We had to buy on bridge because they're all distressed situations. We buy on fixed rate bridge, though. We don't float. We don't want to
Sure.
take the exposure. But on our refinance assumptions, we're assuming a little bit above the current rates right now. Do I believe that's what's going to happen? I don't. But my fear, I know that Warsh, even a lot of people have him tagged as a hawk. Most people don't know this, but Besant, Warsh, both used to work for Druckenmiller. And Druckenmiller is one of the best investors in the world. And so they're very, very smart people. But Druckenmiller came out and told the market, hey, you're reading Warsh wrong. He's not a consistent hawk. He just wants to lower rates while concurrently reducing the Fed's balance sheet. Now, that's a mathematical problem. I can't wait to see how that works out because we're having increasing need for people to want our debt, but the only buyers that really matter are the central banks, and they're all reducing on the net sellers of our debt, and they're buying gold instead. And it's very clear that's what's going on. I think the volume of central bank buying of gold has gone up from, I think it was something like 17 tons to forecast for 2026 to be 70 tons.
Wow.
That's not just a slight increase. That's a paradigm shift. And
Yeah.
what triggered that was February of 2022. Russia invaded Ukraine, politics aside. Instead of going to hot war with them at the time, we decided we would do financial sanctions against them, which included freezing, as I say, but I just call it stealing their reserves. Now, that was anywhere from 300 billion to $1 trillion, depending what accounts you include. But at minimum, it was $300 billion that the U.S. just said, you know what, that's ours now. And that's a line that had never been crossed before. And as soon as that happened, even our friendly allies started reducing their treasury exposure. Because if we look at history, which is a great guide, it rhymes at least, but prior to World War II, outside of which we became the world reserve currency, prior to that, roughly 80 to 90% of central bank reserves were held in gold. And that got as low as right at 10%. Now, we're already back close to 30% now. Is that going to triple? I don't know if it's going to triple, but I know it's going up because now if you're a central bank in Brazil or whatever other country, you're looking over and you're like, hey, Russia's a big boy. They've got a real army. They've got hypersonic missiles, which the U.S. doesn't even have yet. And they've got nukes. And they just stole $300 billion from them. What are they going to do to me?
Right.
And so
Yep.
you have to be the dumbest person at the table to hold as much in U.S. Treasuries as you did before. And so that's a trend that I don't think is going to shift. They're buyers, of gold because they're sellers of Treasuries, and there's just a bid on that no matter what the price, because they've been told to get from 10% to get to 50, 60, whatever the number is, by X date, and so they just buy. And that's what's been going on. That's what's been driving the price increases in the metals. Um, so what happens to the interest rates was kind of back to your question. Well,
Yeah.
it depends, because if the Fed truly could still set rates, which they only set the short term rate, they can't set the 10-year, which is what we would love for them to be able to do. The market sets that rate, and so when they started cutting, people's confidence in the U.S.'s ability to pay went down, and so the yields, as you'll recall, went up even though they started cutting. And there's been this divergence for a period now where the where we've moved from a difference between the dollar strength and bond yields, because usually if we raise interest rates, the dollar gets stronger, yields go down, but it's actually it's actually breaking down, and so it's really interesting to watch. So if we're assuming the Fed's still in control and setting rates, then I think rates are lower. I think Warsh is going to come in and cut, and that would, in a more traditional historical context, that would mean that the 10-year would go down. My fear is that the market isn't going to listen to that, and that rates stay where they are or higher. I mean, I certainly wouldn't loan the U.S. government at 4% for 10 years. There's no way, because I know inflation is going to be higher than that, and that's a losing trade. But now Besant has come in and said he will go in and start buying the bonds and the bills himself to force the prices up, which drives the yield down. And I think that's what they're going to have to do. And that's what they started doing already. They already restarted QE, 40 billion already in January. And they said that's going to continue. So, somebody's got to buy the debt. And I think it's going to be a left pocket, right pocket thing, which means we have to print a ton of money to do it.
Mm-hmm. Yeah, absolutely. Well, another economist that I follow on a pretty regular basis is Richard Duncan with Macro Watch, or Macroeconomic Watch, I think is what it's called. But anyways, he just basically said they're already doing this and buying it. They're calling it something different, right? I forget the name of it, but
it's something ridiculous, RSM or
RSM, like
don't call it QE, but it's
right.
They're printing money to buy their own debt. It's quantitative easing,
exactly,
which is even that's a nice word to kind of hide what it is. But once that has started, once any country has ever started monetizing their own debt, which is what quantitative easing is, they've never been able to stop and go back. And so I'm a probability guy.
Absolutely, yeah. Well, let's talk about what that means maybe for commercial real estate. I've kind of got three things up here. I think transaction volume is going to be up this year, not only because of maybe interest rates, but because we've got a lot of non-discretionary sellers that you're, starting to see kind of come in the market that have to, right? I mean, in the multifamily space alone, I think I was tracking a couple of weeks ago is about $161 billion of debt that needs to be, refinanced, restructured, or sold this year. That alone is going to force some, transactions, right? And if we think about, commercial real estate transactions being somewhere between $500 and $600 billion nationally on average, that's 160 billion right there that has to be redone. So I think that's one thing that definitely happens, this year. But maybe does this mean that there could be some improved deal economics for multifamily operators out there that are well positioned and have cash?
Yeah, I think we're seeing that. There are a couple things there. There's this old saying that's when you're liquid and others aren't, that's when wealth is created, and
Mm-hmm.
That's so true. Whether it's in the great financial crisis, or whether it's now with housing and commercial real estate, we get the call on these deals because they know we have the money and they know we can close. And so something needs to close quickly. We do what we say we're going to do, and so the brokers trust us to be at the table, and even if it's at a lower price. But the cycles, basically what we've seen, and this is pretty typical, is things don't go as expected. Operator struggles. They're not hitting the pro formas. They feed it for a while out of their pocket. As you know, a lot of these multifamily deals are kind of cobbled together. It's probably the same in office and others by a handful of different GPs, none of which had a significant balance sheet of their own. They just kind of aggregated it and got to where they needed to be. And so there wasn't, aren't a lot of pockets to dig into there. So ultimately, they end up doing capital call. Now, if the capital call was just to buy time, pay the excess interest for a period of time until they cut rates, well, then they're going to end up doing another capital call or losing their property. If they were executing their business plan, they were driving revenue higher and NOI higher, and it was proving out, then a capital call might be good money after, it might not be good money after bad. So you get to that phase, and then you get to the lenders were extending and pretending for a period of time. They start getting pressure, and they start taking the assets back. And we're definitely seeing that now. We have numerous bank-owned assets in our markets. But you also see some of the lenders at this point are still reticent to take the markdown. We've had 2 lenders come to us and say, "Hey, just take it for UPB. We can't have a write down. We'll charge a really low interest rate. You don't have to bring equity to the table. We'll give you 5 years. We'll even lower the interest rate on some of the other loans you have with us, but because that doesn't hit the radar for their source of money."
Right.
And we couldn't even come to terms with how we could possibly get to that UPB in 5 years, and UPB being unpaid balance. And so it's basically a free call option, and we couldn't even take it because it would become our albatross. And so some of the lenders made some bad loans, or at least one-off bad loans. I think there are probably a lot of them out there. And then you hit the next phase, and that's where the lenders really do start doing the write-downs, and they just force the full liquidation of the equity in the deal, and it sells for somewhere under the paid balance. And that's the phase that I think we're just starting into. So you mentioned earlier, you don't really know where you are in the real estate cycle till afterwards. And I don't know if we're at the bottom. I don't think we are, but at the same time, I'm buying deals because I'm 100% convinced that dollars today will buy less 5 years from now than they, will buy less 5 years from now than they do today, 100%.
Yeah.
And so we buy through this, and a couple years from now, we'll look back and go, "Oh, that one was at the low."
Right.
When you're buying distress, it is different. We're not doing. It's very rare that we participate in a call for offers because you're, in a designed environment where you guys get the maximum value for your seller, and that's the deal. But I don't want to be in a situation where I'm bidding against myself on a pretty shiny object, and that ended up forcing a lot of bad decisions in 2021 and other years prior to the rate hikes, because they started doing floating rate debt just to make the deal pencil so they could, quote, win the deal, and then they ended up just getting destroyed.
Yeah, I remember seeing so many posts, Bruce, about just was awarded this real estate deal, and I'm like,
so you overpaid more than anyone else.
There you go. So you were the highest payer. That's right. That's exactly right. I think that reigns true 100%. From my communication with other brokers in the market, just anecdotally with the projects that we're working on and the activity levels that are in, I foresee, and Phil Anderson talks about this in The Secret Life of Real Estate and Banking, and so does Akhil Patel in The Secret Wealth Advantage. But kind of this last phase is where people start to see, like, this time is different, and the fear of missing out does pop back in, which reminds me back of what Howard Marks talks about in his book, navigating or the market cycles, which is like this period of time where it's kind of a mania phase. I see a lot of capital. No less than 5 or 6 funds that I've talked to in the last week for industrial outdoor storage have raised $150 to $200 million. Why? Because iOS rents since 2020 are up 123%. So capital has been raised to go buy those assets now. And we listed a project, and in 7 days had 5 offers at ask or above ask. Right. So and I foresee that happening in the multifamily space as well. So it's like this period of time where there's all these warning signs, but there's folks getting into the industry. There's this mania kind of going on and saying, well, this time is going to be different. And that concerns me a little bit.
Yeah, you have to stay disciplined and stick to your assumptions and try to sandbag where you can, so that if there are surprises and they're negative, it doesn't impact your pro forma. But you do have this time it's different, and oftentimes that is a mania, but there is the version of that that's a panic, and that's where you have high inflation or hyperinflation scenario where you get paid in the morning and you have to spend it immediately, because by evening it doesn't buy as much. And so people just start buying anything other than the fiat currency that they have in their hand. And that can drive prices more rapidly than you could ever expect, because you're just trying to store value as opposed to create.
Yeah. Well, I'll just leave everybody with this thought. We'll put a button on this section of the show. Paraphrasing Dennis Hooper from Hoosiers, if interest rates fall, no one's going to want to stand around and watch the paint dry, right? The commercial real estate market, from my perspective, is poised for action. And so just, position accordingly, but also know that, we're kind of sounding some horns here in regards to things that you should be thinking about, things that were happening, 4 or 5 years ago. We could see the same kind of activity from, these assets, especially if the treasury does drop and people are like, this is my time. I need to go deploy and I don't want to miss out. So just putting that out there for everybody to kind of think through and listen to. But I want to kind of transition over to Elkhorn, right? And talk through the investment thesis a little bit. I've done a decent amount of multifamily investing myself and have had some success with that. And I do obviously broker a lot of those real estate deals. And I've always enjoyed and thought that there was a big tailwind around multifamily housing for the things that we've talked about. But obviously things have changed in regards to, when you started investing versus where we are today. But the thesis has remained the same for you guys over this period of time. So, tell us a little bit more about that. I'm just very curious on why you've stuck to it and just, stayed there. Obviously there's operational efficiencies. You start to do better and you build relationships, but there's so many shiny objects out there. Why workforce housing? Why multifamily? What's the thesis behind that?
Yeah, I mean, I wish we owned some pretty shiny objects, but we just prefer to make money. And so,
Yeah.
my wife is funny because in the early years, she's like, "Well, we'd drive by some what she would consider a rough-looking apartment complex. Like, is that like something you would own?" I'm like, "Oh,
Yeah.
that's really nice compared to what we own." So, oh my god, um, you know, for me, we're doing distressed workforce in secondary markets, in large secondary markets, and just work for, because I had a CFO of a company contact me. He's like, "Hey, you guys raise a lot of money for workforce housing. You've done great. How do you make this work?" I'm like, "Well, tell me about your deal." Well, he was in Dallas and he was paying 200 plus K per door, and his rents were higher than mine, maybe 20, maybe 30%, but he's paying 4x for the doors that I
That's
was
right.
doing. And I'm like, I don't know how you can make that math work, honestly, unless you're assuming lower cap rates in the future, and that's super risky to buy. We buy things that we say they're broken, and if we fix anything at all, they're going to be worth more. And when the music stops, like it did when the interest rates spiked so rapidly, transaction volume plummeted, as you well know from being on the front lines.
Yep.
We were like, well, we were going to sell these couple over the next year or two, but we'll just sit on them and start distributions. And so it's not going to change our returns. And so you really have to be positioned safely. Workforce housing, to me, historically, it's been one of the most economically insulated components or subsectors. I don't want to be the guy that's out buying the Class A in Uptown Dallas, because you know what? There's another Class A going up right next to it that's going to have something newer, brighter, and shinier. And we jokingly say that our amenities are showers and toilets and sinks, and they might get disposals. We'll see. But they need places to live, and we don't do Section 8. We're above that, but these are that whole segment has been often neglected by owners. They're often owned by owners that have owned it for a very long time, if it's in the secondary or tertiary market, and they just bleed all the money out of it. They don't do the repairs, and so they end up with a half full property that they have no inventory to rent because none of it's been repaired. In Dallas, you couldn't find a 60s or 70s vintage deal that hadn't been value added probably 6 or 8 times at least. And there's just so much capital chasing them. I just don't know how you get a competitive advantage. And those are people posting saying they want a deal. Now, the fundamentals are great, and there are select good deals in the market, but I think there are fewer than they're certainly being marketed. That's without question. So we like workforce. It is an area. If you look at what the administration is looking to do, they're looking to reshore a lot of manufacturing. Those are workforce jobs. I look at Tulsa. Tulsa as an example. It's one of the markets we're in. Huge growth in workforce types of jobs. But they don't build workforce properties. It's very rare because it might cost me 20% more to make an A property than a C.
Yeah.
And so why would I build a C? And so they just don't. And so they age in. And so the inventory actually of workforce in that market has gone down. And so inventory is going down, demand is going up. That means we can raise rents and we'll stay full. It's just simple. It's not rocket science. It is a
Well,
lot more work. Don't get me wrong. I mean, you have to
yeah.
be very, very hands-on. We struggled for a while using third party. We brought property management in house about 3 years ago, and that was night and day, absolute night and day. And you can't let these tenants feel like they have a substitute teacher that isn't really monitoring things, because the class will be chaos. And so, I've looked multiple months recently, and the end of month or greater than 30-day delinquency is a few $1,000s on 15 100 to 300 unit properties, close to 2,500 plus doors, and a few grand across the whole portfolio.
Well, I kid you not, I was with a developer last week, and he's like, I got some land. I'm going to build this new multifamily property. And I'm like, okay, let's run some numbers real quick. What do you think you're going to need to get for, rents? He's like, well, $2 plus per square foot. I was like, yeah, that's probably right. And, we start running the math, and we're like, okay, well, let's use a 30% operational expense ratio. And I said, what's it going to cost you to build? And, all in was like, $45 million, and it was worth at the end of it, like 38 million. And I go, so, and he goes, well, this is why the incentives are important. And I'm like, so your deal is a merchant development deal baking on incentives from multiple municipalities to make it make sense. Yeah, that's how these deals work. And I'm like, understood. And I get it. But like, that's not the thesis that I'm super excited about. Right. So totally understand that. Well, Bruce, this has been wonderful. I didn't get through all of this navigating the market uncertainty. We'll definitely have to have you come back on in a couple months to talk through this. Got to get to my favorite segment of our show here. So, knowing that you've got all this information, I'd love to hear maybe what your favorite book is, or a podcast, your information source that you're reading on a regular basis. Are you sifting through, BLS data on a regular basis? And I see all those screens behind you. I'm like looking at these charts. I'm like, this guy's not reading books. He's reading the markets, man.
Yeah, it's I try to get the raw data directly as much as we can,
Yeah.
because the headline narrative is often sometimes intentionally misleading. I mean, to the extent that we've actually even downloaded all the U.S. government debt securities, looked at the maturities, assume that they reset at the same maturity, and see what's going to do to interest rate or to interest expense. So, geeky stuff that most people don't care to do, they can just follow me and I'll do it for you.
Yeah.
But
Absolutely.
favorite book. I mean, there's so many in the real estate that are impactful, and I'm sure I know this is one of Amy's favorites. One, I think I like books or podcasts that just kind of make you think differently,
Mhm.
or poke at your own thesis. I love for people to take the other side, because if I can't defend it, then I know I might have a hole in my thought process. And so
Yeah.
if I can poke holes at theirs all the day long, then it makes me more comfortable. So, one of those things that makes you think differently, I think, is The Creature from Jekyll Island.
Yes.
Once you realize that the Federal Reserve is not federal, it's not governmental at all, it's a private institution, and it's not a reserve. It is really designed for all the banks to offload losses on other people. It's very, very eye opening. One that I wrote, or that I read, that made me think a lot during the GFC was, um, it's a lot more esoteric, but I think it was called The Great Depression, a Diary. Now it's not, you might need a beer to drink with it for sure, but it was literally a guy that was living during that period of time that kept a diary and notes on where the markets were and how commodities were behaving and all that, and who was wiped out and who wasn't. And it really, debt is a great instrument for investments, but it also kills. And so leverage can kill. And that was a great lesson out of that. Podcasts, I really like How I Built This. It's a great, it's inspirational. You hear these guys that built billion-dollar companies, and a lot of them were just scrappy in the garage to start. So I like to listen to that quite a bit.
Absolutely. Well, I heard a quote the other day. It said, "If you can't defend your opinion, it's not your opinion; it's somebody else's." Right? And I think that's very, very
Absolutely.
true. So, we talked a lot about economic indicators today, but is there one that you're watching more than anything else right now, or is it that federal debt that you're kind of watching?
It's really the debt, and
Yeah.
in line with that, one of the most important things is probably M2, which is the money supply
Hmm.
growth. And if you look at money supply growth, it's been incredibly substantial, obviously. And inflation lags that by about 18 months. It's not immediate, and so that could be putting upward pressure here shortly on inflation. Um, we'll see. But I look at a ton of stuff, but M2 would be important. You can get it right off the Federal Reserve, and just look at the graph; it'll graph it for you. It's, that in the U.S. government debt. Those are the drivers for my thesis.
Absolutely. Well, there's Amy saying Creature from Jekyll Island is a top 3 book for sure. So thank you for being here, Amy. We appreciate that.
Yeah, for sure.
All right. Well, thinking back, there's probably a lot of younger investors listening in today are going to listen to this. If you could give your younger self one piece of advice, before getting into real estate investing, what would it be looking back now?
Yeah, I've told this story before, but I was at a multi-family conference when I was just starting to think about it and consider it as an asset class. And they have these breakout lunches, and I sat next to an older investor at the time, and I asked him for the same basic question: what would you advise somebody that's thinking about getting in? And he's like, just buy something. He said most people never take the step of actually buying anything, and he said it may be the worst deal you ever buy, but you'll learn so much from it that you'll be off and running. And I've heard that from a lot of people. So many people have analysis paralysis. They think it's great. Or right now they've been waiting for prices to come down. You know what? Guess what? They have come down. And could they go down more? Maybe. But if it works at today's interest rates, it's going to work great if rates do go down. And the administration is doing everything they can. They're saying publicly that they're going to force rates down if they have to. And so I'm going to believe them. And if rates do go down, these are home runs. But if not, we make good return. I mean, borrowing at 5-6% is normal historically. If the deals don't work there, then you shouldn't buy them. But exactly. I'd say just get started to do something, even if it's something small. I started off doing single family like a lot of people, and got into small multis pretty quickly. But I just like the scale of multi. They're actually easier, I think, than single family rentals because you have a manager on site and everything else.
Bruce Fraser, everybody. Hey, Bruce, if they want to follow you, learn more about Elkhorn Partners, point them in the right direction.
Yeah, I mean, 2 places. I would encourage you to reach out to me on LinkedIn directly. Bruce, just Bruce Fraser, Fraser, with Elkhorn Capital Partners. I don't post super frequently, maybe every month or a couple months, but it's always macroeconomics. You're never going to see one of our deals there, or inspirational things. It's just me talking about what I see and trying to cull it down for everybody to kind of tell the story of what I'm seeing. Or our website's elkhornpartners.com, and you can reach out to us on that as well.
Excellent. Bruce, thank you so much for being here. I very much appreciate it. Just a masterclass here today. If you guys are interested in Kansas City commercial real estate, you can find us at mwcreadvisors.com. Thanks for tuning in to another episode of the Kansas City Commercial Real Estate Market Pulse. We'll be back here live again tomorrow and next week. So thanks for tuning in. We appreciate everybody coming in and dropping all of the knowledge. Bruce, you shared so much with us to learn, to go review, and to think about. So thank you for being here.
Thanks, Logan. I appreciate it.